Welcome, everyone, to the Financial Thought Exchange podcast. This is where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Lotta Moberg. Today, I have two guests that are reoccurring for our longer conversation about the piece that they're writing for the Research Foundation. We have Thomas Idzorek, who is Chief Investment Officer of Retirement for Morningstar Investment Management, and Paul Kaplan, who is now retired, but was formerly Director of Research for Morningstar Canada. Welcome, gentlemen.
Welcome. Thanks for having us. Appreciate being back.
Thank you.
Welcome back. And we're discussing the piece that you wrote for us, which is the piece you authored, which is Lifetime Financial Advice, a personalized, optimal, multi-level approach.
Boy, that rolls off the tongue, huh?
It does. You worked a long time on that title.
No, I don't know about that.
So I thought we'd just kick this off with a little bit overview, but I really want to get into some of the really meaty part of your approach, so we can start building our framework and educating our viewers and our listeners about how to think about this holistic approach of yours of lifetime advice, really. Now, early in the book, you make this claim, and I want to ask you about this. And you say that financial planning is fraught with material inconsistencies related to such things as risk tolerance, investor risk profiling, and financial models. Maybe you can start by just explaining what you mean by this. Where are those big gaps? And maybe give a broader overview of where we're kind of going with the framework as a whole.
Yeah, that's a good question. And I hear that. I was like, well, boy, what am I exactly thinking there? But so in my mind, risk tolerance is become kind of the dominant way in which financial advisors and financial planners tend to give advice. And this often, involves them in administering, something akin to a risk tolerance questionnaire. That risk tolerance questionnaire is scored, and then whatever portfolio or account that advisor is managing, in this system, or not our system, but the system that I think is, in the industry, that portfolio is, invested in a way that corresponds to whatever that specific preference is. And, kind of a key part of our framework is that one needs to take a much more holistic view of the person in question, and really understand not only the risk preference, but a variety of other preferences that they would have, and think about them and their lifetime holistically. And one would want to consider not only what they hold in a specific account, but they would want to consider all of their assets. And one of the key assets that we'll end up, talking about at some point in time is one's human capital. And for a lot of people, human capital is more, let's say, bond-like than stock-like, and that influences how their financial capital should ultimately be invested. And to the degree that people have multiple accounts, if one account is perhaps not easily tradable or could not be changed for some particular reason, that would absolutely influence how other accounts are invested. And so rather than just adhering exact or applying that risk preference or risk tolerance directly to one account, we think that it should be applied at the broadest possible level. And for that really ends up meaning kind of the total economic balance sheet of an individual, where we think of that economic balance sheet as being kind of the best representation of somebody's overall financial situation and well-being.
So the difference between how generally the industry defines risk tolerance and the way that you're doing it's not a matter of kind, but scope, what you actually apply the risk tolerance metrics to.
Right. Again, I think that it's so often applied myopically, in which, that risk tolerance questionnaire is taken and applied specifically to an account. And one really needs to have a holistic, balance sheet oriented approach to that investor in their total economic situation. And then in light of their liabilities or how much they want to consume and the nature of their human capital, plus I'd say other preferences, like how much do they want to maybe leave to their heirs, or how much do they value kind of their own consumption versus perhaps leaving a legacy. All of these things end up influencing how they should be allocating their money through time.
Excellent. So you give it.
I'd like to add to that. Yeah, I mean, in order to develop a holistic framework for how someone should manage their finances over their entire lifetime, we believe you have to start with a holistic approach. And that holistic approach is known as life cycle finance. And life cycle finance, has its roots going pretty far back. Probably the first instance of it was put forth by the economist Irving Fisher back in 1930, when he talked about the idea that you want to smooth your consumption before and after you're retired. These ideas were further developed by various Nobel Prize winning economists, including Milton Friedman, Franco Modigliani, Paul Samuelson, and Robert Merton, to name some.
Yeah, you had a list of that in your piece. Actually, maybe we should pull that out while you're speaking, perhaps.
Yeah.
Go ahead. If you put the list of yes, thank you.
Right. Mm-hmm. Right. So these are the economists. They all are Nobel Prize winners, and they're all Nobel Prize laureate. They're Nobel laureates, and in a number of cases, the Nobel Committee cited their contributions to life cycle finance as the reason they were awarded the Nobel Prize. But other ones, that may not be as familiar as their work on life cycle finance, but they also made important contributions. So what we are trying to do really in this book is bridge the gap between theory and practice. Here's the theory has been developed, and yet it seemingly has had little influence on actual practice. So we hope that what we present would kind of provide a bridge to ultimately to the way financial planning is put into practice, and put in a way that's consistent with life cycle finance.
Yeah, that's great. So you had early on in your piece, there's another overview and illustration of that. I thought maybe we want to speak to that, really kind of giving the full. Let's see the other slide there. I was thinking about, yeah. So there's a lot of things in here, and I know that it explains a lot, but it does need some explanation. So maybe we can start here to get just the overview of the framework.
Well, I'll try to do that. So sometimes we call this our gear chart, and the book is organized into 3 parts. Each are kind of reflected in this chart. You kind of at the highest level, we have what we refer to as our parent model, which is the life cycle models, and I think that's what we're going to primarily kind of dive into today on. But the life cycle models are I think at the highest, most strategic overall level, providing kind of those big picture answers for what people should be consuming and saving, and how they should kind of in general be investing across their life cycle. And in our model that we're presenting, that's really in part 1. The output of that model ends up feeding into, our child model, which is, a balance sheet oriented net worth optimization that is updated through time based on the person's evolving circumstances and the evolving running of that life cycle model. And then the target asset allocations that are coming from the net worth optimization, kind of our middle model, the part 2 of the book, feed into, I'm going to use the word tactical. I don't know that I want to, but it is, very much where the rubber meets the road in terms of on an ongoing basis throughout the year, what is the person kind of buying and selling across their numerous different accounts and account types to as part of the overall investment plan. And again, earlier you were kind of asking about, kind of risk tolerance. Well, so often, risk tolerance is maybe getting applied at the lowest level of this chart, at the account level. Maybe it's up a level in our child model where somebody's working on the asset allocation. And again, when risk tolerance is talked about often in the context of a life cycle model, the broadest strategic view, that's how we want to think about it. And that view is, really holistic in nature, again, considering all aspects of that person's financial situation.
And another illustration you have shows kind of what we're expecting here over life cycle here.
And
I like
maybe I'll let,
yeah.
Right. Well, maybe I'll let Paul, take this a little bit. Paul, I think you want to describe kind of how somebody's life cycle evolves through time.
Yeah, I mean, this is basically the kind of the central message of life cycle finance. So you start off at the beginning, when you're young, and you have your whole career ahead of you, and you may have very little in the way of savings. So you don't have too much to invest, but you do have what's called human capital. That's when your human capital is high when you're young, because human capital is basically the present discounted value of all your future income, which before you retired consists of your salary, and after you retired would include any kind of defined benefit or social insurance that you might be entitled to as well. And that over time, as you can see from the starts on the left in the green area, and it does start to decline. But as it declines, the blue area, which is financial wealth, accumulates. So basically, as you are working, the idea is that you should be saving part of your earnings and investing them, and over time you'll build up your financial capital until you're retired. Then once you're retired, you can see on the right hand side of that blue section, it starts to go down, because once you're retired, you're living off of what you've achieved through your saving and investing over your working days. So that's basically what this is about. Then on the top, we just add the two together to just show the overall pattern of wealth. And the important message here is that your wealth does not merely consist of your financial wealth, but it does include, you need to include your human capital. At the very bottom, it notes that in the beginning period, as I mentioned earlier, you're accumulating, into your financial wealth. You're saving part of your salary to accumulate, and then once you retire, you start to decumulate. And there's another layer here as well, which is that in your working years, you may be concerned about that you might something could happen to you. And you would no longer be able to, and you will no longer be working. Well, certainly if you pass away, and that's a loss of wealth to your family, because they don't have the human capital anymore. So what you do is you buy life insurance, and you buy enough life insurance to make up what basically what you're going to be losing losing a human capital should you pass away early. And then but then in your retirement years, you switch over to annuities in order to generate a guaranteed lifetime of income that you'll need over your retirement years.
No, that's really helpful. So we want to really dig into the human capital part eventually, as soon as we get there. Just to talk about first, when it comes to risk management in the portfolio itself, we want to talk about how we get to the conclusion of what should be the appropriate risk in the portfolio. But you do talk about it in terms of equities versus bonds a lot. And I wonder how you think about that in terms of equities versus bonds being the appropriate way to think about like the 60-40, and then you do different weights from there, knowing that a lot of companies that issue bonds, for example, can be quite risky. So some of bonds, and you don't have the any inflation hedge component into bonds. How to think about that in terms of is that the appropriate risk balance for when we're constructing the portfolio?
Yeah. The problem with the 60-40 idea is that it's only applied to your financial wealth. But as we just showed in the previous chart, you have to take your human capital into account as well. And you also have to take your liabilities into account, which is the present discounted value of your non-discretionary consumption. But let's just talk about with human capital for a moment. When you start off and you have a lot of human capital and very little financial wealth at the beginning of the life cycle, most people's human capital is very bond-like. Although there's some people where it's more stock-like, and we like to use an example that was actually put forth by Professor Moshe Milevsky at York University. He published a book called "Are You Stock or a Bond?" So if you are a tenured professor, then you are a bond. You have a guaranteed income until you retire. But if, let's suppose, you're a stockbroker, and your ability to generate income is tied to what happens in the market, then you're more stock-like. So someone who, let's say, is the tenured professor, has very bond-like human capital, and therefore has a great what we call risk capacity. He can take on more risk in financial wealth, because it's like you're holding a lot of bonds, and so you can balance that with stocks. If you're the stockbroker, then you're already basically holding something that's very stock-like in your human capital, and therefore your risk capacity is much lower than the professor's risk capacity. We think this is really important because, unfortunately, risk tolerance and risk capacity often become conflated in practice. And it's really important to keep the two concepts distinct, because your risk tolerance is what determines what your overall portfolio or your overall balance sheet should look like, not just your financial wealth, but taking human capital and liabilities into account. Whereas risk capacity is a statement about how much risk you can take in your financial wealth. So it's really important to keep those two concepts distinct.
So I would add, I was just going to add, so ultimately with your financial capital and how you choose to invest that with, between stocks and bonds, you're doing that in light of the rest of your balance sheet. And so that, the point that Paul was making. But so, the premise of your question is correct, is that we are using stocks and bonds within your financial capital to control the risk, but the risk that we're focused on isn't necessarily the risk of the financial portfolio in isolation. It's of the total balance sheet.
Yeah, that's helpful. So and let's go back to just when we talk about risk tolerance and risk capacity, I was thinking about it as meaning risk tolerance is more my subjective perception of how much, like my mental kind of, am I going to freak out when there's too much volatility in the market? Risk capacity is more of that. My financial circumstances are such, or my human capital is very volatile, and therefore I have less risk capacity for that. Is that an appropriate distinction, or does that clash with any of how you?
No, I think it's a good distinction, and one that people just need to be very aware of. And so to me, this is sometimes a problem when somebody is filling out or completing, say, a risk tolerance questionnaire. Is it directly getting at their pure attitude towards risk, or is in the back of the mind of the person that's completing it, are they thinking about their goals? Are they thinking about the health of their balance sheet? Are they thinking about their risk capacity? Are they thinking about the nature of their human capital? And then answering in light of that. And, I think it's very unclear. And therefore, that's one of the areas where we think that achieving clarity around what is really getting measured when somebody is taking a risk tolerance, that is important. And of course, as you do that, you have to then take into consideration, how do I plan to take the response to that risk tolerance measurement system or whatever it is, and then how am I applying it? And again, from a theoretical perspective, we're arguing that the most appropriate and most powerful way to apply this is we need to think about somebody holistically. What is their total ability via their balance sheet to take on risk, and apply it at that level?
Yeah, because in your framework, you do boil it down to a risk tolerance factor. And that one would then include both my mental capacity and my actual objective circumstances. Which part do you think, generally, if it's fair to say, which of those two, the subjective and objective, kind of is the most impactful, do you think, in the ultimate asset allocation that stems from the risk tolerance metric?
Yeah. Yeah. So risk tolerance is subjective. It's a preference. Economists call it a preference parameter. And basically, it's your attitude towards risk. It is independent of your circumstances. So we assume you have the same risk tolerance when you're 25, and you have the same risk tolerance if you're 105. But your portfolio will look very different because your risk capacity differs. So risk capacity varies with circumstances. Risk tolerance does not.
And so maybe I'll jump in with so in a typical life cycle model, when you have, received somebody's attitude, their preference towards risk, and you're applying it to their balance sheet, we're thinking of that as being constant. Now, of course, like all models, one has the ability to update these models. So again, even though we're assuming that person's risk tolerance would remain steady throughout their life, given that their whole balance sheet will be evolving and how they should be investing will evolve with that balance sheet in light of constant risk tolerance, it is still, of course, possible that people's, they have life experiences, things change, and perhaps their attitude towards risk will in fact change, and one can model that and incorporate any sort of update in risk tolerance into the model if and when that change in attitude occurs.
Yeah.
And the practical application, implication of this is that a risk tolerance questionnaire should just be that. It should get on what is the attitude of the investor toward risk. It should not depend on circumstances.
Yeah. No, it's so where we're going with this balance sheet approach, right, is that the risk tolerance is a factor that comes in as a subjective parameter, and as they mentioned, something that in most cases will remain constant throughout a person's lifetime. It's your mental disposition. The risk capacity does get into the model, but not through the risk tolerance factor. It's a different thing, and it comes up from modeling the whole balance sheet. There'll be components, as we touched on, and we want to touch on more, the human capital part being very volatile, well, then you have less risk capacity. So it comes in there, but in that way, right, it's a holistic term. There's no one thing that is the risk capacity that is like the risk capacity factor, like we have a risk tolerance factor in your...
Right, risk capacity is dictated by one's circumstances and the nature of their human capital.
Yes. And just to be precise, we should refer to risk tolerance as a parameter. That's because that's what it is. It's a parameter in the model that reflects the attitude towards risk of the investor, and the notion would be that you can, if you can build a properly constructed risk tolerance questionnaire, you can ascertain what their risk tolerance is. Whereas risk capacity is basically something that you have to look through the model as a whole. You have to look at the whole balance sheet. in order to understand what their risk capacity is.
How often do you think they kind of balance each other out? If I think about like an entrepreneur, startup person who owns a few companies, that person's human capital will be quite volatile and risky, which should mean that you have a lower risk capacity. And therefore, it's that person's like financial part of his wealth that is financial should be lower risk than average. But we wouldn't in reality expect that. We would expect that a person who generally takes a lot of risk in life also is the person who has picking stocks and having a high risk investment portfolio. What would you expect there?
Right. I mean, you kind of picked up on it, like to build on the example Paul was giving, the tenured university professor, right, has, if you think about the cash flows associated with their paycheck, so their human capital, they're extremely steady. And then kind of in the example, in that person, their attitude towards risk might be that they like risk or they dislike risk. And then in your example, you have the entrepreneur who has a very volatile, I'll say equity-like, perhaps even startup equity-like volatility associated with the cash flows that they will be earning throughout their lifetime as a result of their human capital. Now, again, ideally, one should separate out what is their attitude towards risk. That person, again, you made the subject, they may like risk. Now, again, chances are from an investment perspective, they need to be very conservative in how they're investing their saved money in light of the very volatile nature of their human capital.
Yeah, and this is also, I think, illustrates the importance of having a holistic, rational approach. Because, if this person, this entrepreneur, and basically has a very volatile human capital, comes to a financial advisor, the job of the financial advisor is not to reinforce their the client's preconceived notions. It's to try to persuade them to do something that they wouldn't have thought of. So someone like this, coming to a financial advisor who, let's say, is using a model like ours, and would be able to have that conversation about, you already have so much risk going on already outside of your financial investments. You really need to be conservative in your portfolio.
And on the other hand, if you meet with that college professor, you would think that you would talk that person into have a higher risk portfolio. It sounds like that's an unlikely scenario. Or you would ask them also, and what is your risk tolerance? And he would say, my risk tolerance is low, which is to be expected. And then when you construct a portfolio that is high risk because he has high risk capacity, he will be quite upset and say, I told you I have low risk tolerance. What are you doing?
Well, I don't think the ideal thing is to directly say, a person to directly state their risk tolerance. I think a risk tolerance questionnaire would probably be, if properly constructed, would be the proper instrument. And then it's not a question of, what your risk tolerance is. You can just say, look, you took the risk tolerance questionnaire, and here's how you scored. And that's what I'm going to go by.
So also from a high level perspective, then as we get closer to saying how we actually implement this, if we think about risk tolerance, applying, as you write, both to one's net worth. And net worth is not what most people think about what it means in tax world, but rather a combination of all financial assets plus human capital minus liabilities, and the liabilities are both human liabilities and financial liabilities. So that's kind of where we're going. And the big question people are asking right now is, how do you implement this in practice? So I don't know if you want to give anybody some nuggets there, or we can go through all the components and we'll get there eventually.
Right. Well, maybe we'll get there, but I think a key kind of view that Paul and I have is that the economic balance sheet of an individual is critical. And, in today's practice, it's not part of the practice. People do not see, companies all the time, right? They get to see what their balance sheet looks like. Individuals generally do not. Again, you get statements in the mail that, generally, what is your brokerage statement? What is your 401k statement? And these are revealing, let's say, pieces of that economic balance sheet, but not the total balance sheet. And again, kind of one of our calls for action amongst, the planning community is to really put the economic balance sheet front and center as part of a planning practice, and to, providing advice to individuals and keeping them informed of how healthy is their overall situation through regular check-ins on that balance sheet.
Yeah, great.
Yeah. So what I think what we're saying is that, number one, we think it's important for financial planners to embrace the economic balance sheet viewpoint, and number two is then to basically convince their clients that that's the way, this is the way they should be looking at their situation.
Yeah. So another part, if we talk about risk tolerance, we also think about volatility as a little bit of a static measure. And you do get into a snapshot of our portfolio and also how to think about this more dynamically. I wonder how you would describe, as we're introducing this whole approach, the role of time horizons. What does a person's time horizon mean, in the sense of, we also often think about it as you have a long time horizon until like an outlay and liability, and therefore you can take more risk. But there seems to be a difference when I go through your work in terms of how we think about a time horizon versus risk tolerance, and it's not they're not always the same thing. And I can go into it more, but curious what your thoughts are there, high level.
Well, they're two different things. Risk tolerance is the attitude towards risk overall, economic balance sheet approach, and time horizon is there is no one single number that should be a person's time horizon. That's another problem that we see in practice, where maybe some financial planning software just says, what's your life expectancy, and you punch in a number, but then it doesn't get it. What happens if the person dies before then? What happens if the person dies after that? One of the integral components of our approach is we do take a holistic approach to modeling mortality over time. So for every individual, there is, and the factors that we identify, in this, of course, in your current age, your sex, and then any other sort of longevity factors that you take in place. So, for example, if your parents and your grandparents lived very, very long lives, chances are you're going to live a very long life, and so that gets included in the model. Or the opposite, if your parents and grandparents had very short lifespans, you include that in the model. So those are basically the three components: age, sex, and, let's say, family history of longevity that go into this. And the model and our approach takes into account what are called survival probabilities. We calculate a survival based on those three factors. We calculate a survival probability for each and every year into the future, and that we think it gives you a much better approach than just assuming a given lifespan.
And so the way I would say it is, we're including time. It's just we're not calling it time horizon, which is typically a very specific number. So again, as Paul has just said, when you're thinking about, let's say, the right-hand side of your balance sheet, your liabilities, your non-discretionary, consumption, for some people, they're going to live to, 70 years old. There's other people that are going to live to 110, and you can figure out the probability of surviving each year. And that enters into what is essentially the mortality weighted net present value of that liability. Likewise, like if you're thinking about somebody's human capital and how do you come up with a capitalized value of that, you're taking into consideration time and how long this person is likely to work, and what is the mortality weighted, again, net present value of that human capital. And of course, these are two of the critical entries into that economic balance sheet. So time is absolutely in there. It's maybe different than time horizon.
Yeah, because I was thinking about it also at the.
Well, just I mean, this model, this longevity, model of mortality and longevity, it permeates everything in our model. It's baked into everything, and one of the things, of course, that it gets baked into too, is how much life insurance should you buy when you're working. Well, that obviously depends upon what your mortality rate, how that's going to change over time, and similarly when you're retired, how much you're going to have to pay for an annuity. It's going to depend upon your these mortality factors.
Yeah, and I was thinking also about time horizon as more like a risk tolerance, like a subjective concept. We're doing, in addition to the series around your piece right now, we're also doing another series on alternative credit, and that space is interesting. And a lot of what people talk about private markets, their benefit is this notion of people are not able to sit on too much of like, people want liquidity, basically. They want to be able to take money out if they need it and if they want it right now. And that kind of is a mental capacity of a kind of a time horizon, whether you want to see your money move a lot or whether you're like, I like to just have one portfolio, forget about it, and check in 20 years kind of thing. So that being a more like a mental disposition that would maybe fit into the risk premium, but maybe it's a time horizon premium that's a completely different factor.
Well, yeah, I mean, we don't have anything called a time horizon premium.
Right.
It's just however, I mean, it's just however those mortality, calculations, they're baked into all the calculations and however, whatever the impact is. So if you change the assumption, like if you assume you're going to, live longer than people people in your cohort on average, or you're going to live, or you have a shorter lifespan, that's how it's going to affect it. But it's not a risk tolerance effect.
Right. Now,
it's a mortality
Paul, it's
effect.
Not Paul Kaplan here, but, Paul Samuelson, is one of the, kind of fathers of life cycle finance, if you will, and whose work we're, putting forth here. He did kind of the seminal work on the idea that regardless of time horizon, that doesn't influence necessarily how you invest. But then when you expand in kind of life cycle finance to consider the changing nature of human capital, but especially of that non-discretionary consumption liability, that influences how you invest. And to the degree that you have consumption that is coming in the near term, it would make sense that you would defease or mitigate, let's say, the risk of that liability with offsetting assets. Now, that asset might be your human capital to pay for that ongoing expenses, but for something that might be a lumpier, larger purchase, again, it may very well be that the way in which you are reducing the risk of that or the volatility of your overall balance sheet is by investing your financial capital in a way that's helping to defease or mitigate the nature of that non-discretionary consumption.
So we touched a little bit on human capital. Let's delve into that directly now. Maybe we should give our viewers here a definition. What is human capital, and like how do we measure it? What goes into it?
Well, I'll go and ask Paul to add in anything that I leave out. So again, I think from our perspective, human capital is the mortality weighted net present value of all future, I'll call it, labor income or income, that is derived from you coming from the fact that you worked. And so, again, this would include your paycheck. It would include, matching funds that you might receive in your 401k, and kind of big components that it would have is it would, kind of include that deferred labor income in the form of Social Security or social insurance, depending upon where you live. And if you are lucky enough to work for a company that offers a defined benefit plan, which, is going to pay you conditional on you being alive, that too is a form of human capital. And we are ultimately attempting to model the expected cash flow characteristics of that cash flow stream, and then mapping that into, a combination of, let's say, bonds and stocks to form an appropriate discount rate based on the volatility of that human capital, and then come up with the overall capitalized value. And as we've somewhat already touched on, a tenured university professor would have very safe human capital. So the discount rate that one would apply to that cash flow series would be a low one, resulting in a larger, all else equal, amount of human capital that then would, for our purposes, would be modeled more as a bond than as a stock. And then, for your entrepreneur, investment banker, equity, fund manager, perhaps, they would have more volatile cash flows associated with their human capital, be less dependable. One would arguably, they might be higher cash flows, perhaps, but you would ultimately be discounting them at a higher discount rate to turn them back into a mortality-weighted net present value.
Yeah, just to add a little bit more detail, to that. So let's go back to the tenured professor. The tenured professor has a very predictable income, and therefore, when we take the present discounted value of his projected future income, we're going to use a fairly low discount rate. So as we take the projected value in the future, bring it to the present, it's going to be discounted at a low rate. And now the stockbroker, his income is very, very volatile. And so the projections that we would make for his future income are very, they're very wide. But we basically take the center point of each of those ranges. But because it's riskier, when we discount it to the present, we have to use a high discount rate. So there's a difference, not only in the, in the values. Now, the projected future income of the stockbroker is probably much, much higher than that of the professor. But when we calculate human capital, we're going to apply a higher discount rate, which means we're going to come up with a lower, each of those future projections are going to become a lower number when we take it down to the present and we calculate human capital.
So we can think of human capital as a stream of cash flows in the future. I'm earning $50,000 today, for example. I'm not, but and then it will grow over time. What do we actually, when we model something and we want to put in the financial model, we generally use returns and risk, and that is what you're using as well. How do we think of return on human capital? If you say the return on my human capital is 7%, what does that even mean? Does that mean that the $50,000 I made today was 7% of something else? And what is that something else, if so?
It's basically calculated the same way as the return on any asset. So basically, I have my human capital, today, and I have some income this year. And then what I do is I project out what my human capital will be next year, what the human, I'm going to calculate human capital a year from now. Well, that human capital is like the value of an asset. So just as with any asset, we would take the income for the year, add the value of human capital for that year, and then divide it by human capital, what human capital was the previous year, minus 1, and that is the return on human capital.
So
I guess what I was going to say is, I don't know that we talked about it too much in the book, but there's the kind of the concept of salary curves, and so people with perhaps different degrees, different levels of education, working in different fields, the growth rate of typical salaries for different types of careers, that can vary. And one can, of course, incorporate that into the model. I guess kind of just getting a little bit back to this kind of idea of, a capitalized value of somebody's, future earnings. In my opinion, this endeavor is not necessarily that different than when you're looking at, say, like a company or even a bond. You can, for a bond, it's very easy to project out what their future cash flows are and then discount them back and come up with what is the net present value of that cash flow stream. If you're looking at a corporation stock, as an example, you have a bunch of analysts, they're attempting to forecast future cash flows, future earnings, future revenue growth for that company. And then based on their assessed volatility of those cash flow series, discounting that back. And I would say this endeavor, for different careers is not that different, where, one is, again, essentially thinking about what is somebody's paycheck essentially going to look like for the rest of their life. Do they have access to Social Security? Are they paying in? Do they have access to a DB plan? And then, again, what you're doing is we're modeling that as a combination of stocks and bonds based on the riskiness of it. And again, the purpose is really not to project out, a different value, but to capitalize that and understand what is the value of that asset from a balance sheet perspective that person has at this moment, and then through time.
Okay. So one difference here that we're looking at when we're thinking about, if I buy a bond, say there's a negative cash flow, there's a positive cash flow in the end, and in between there are some coupons that is happening. Here, we're not looking at the negative cash flow as an investment in human capital, such as I paid this much for college and this is my return, which is going to be astronomical numbers in terms of return numbers there. Rather, we're constructing and calculating what will be this balance sheet kind of position that is human capital, that is this thing, which is discount all the future cash flows, and this should be the value of something. Seems to me that the calculation does become, I shouldn't say circular, but the return of human capital depends on whatever discount rate you put in there to make this kind of human capital mass bigger, right? Or smaller, right? So you can, if you say that my human capital is like a bond, therefore I'm going to discount it with a real return of 1%, that means my human capital is bigger than if I would have discounted it with a higher rate. And therefore my return on human capital is lower because it is the yield from the human capital I had to begin with. How to think about that? This seemingly a little bit circular, but how we think, where we get the return on human capital numbers from.
Yeah, it's definitely not circular. The discount rate we have, part of our model is we do calculate the discount rate, for human capital. That's based upon how we model what combination of stocks and bonds we model human capital as being. So there's nothing circular in there. And as far as I think you were mentioning the what people paid for their education, that's not part of the calculation. We simply assume the person is currently working, and we know their current salary, and we know what their education level was, but their education level is used to project out how their salary is going to unfold in the future. But there's no dependency on how much they paid for their education.
But if they did take out a loan, that would end up being part of their non-discretionary consumption liability, that they would owe that money. It would be modeled as part of what they need to pay for moving forward. And so it would be captured. So if they had $100,000 in loans and they needed to make those payments, that would be part of the non-discretionary consumption that they will have to be making, moving forward until that's paid off.
Yeah. I do recall you model human capital on basis of education. Is that the best? It is an important metric. How much is it that work experience, things like that, would matter just as much as education in today's world?
It would
Especially
matter.
when, yeah.
It certainly matters. And again, so to me, this is always an individualized, exercise, right? Where somebody's current salary is likely reflective, right, of whatever experience they have. If one thought that their current pay, for example, was well below what it is going to be in the future, that one has the option with these types of life cycle models to do a what if you will, and model that with a different number and come up with a different set of answers. So I'll just say that, these types of models are very, flexible, and of course, always hyper personalized based on the unique circumstances. And that's where an advisor or a planner working with an individual needs to be able to solicit appropriate, good input in terms of what does somebody's circumstances really look like.
You also assume that the wages decline around like year 50. Is that kind of an average of when people actually stop working? That surprised me too. I was thinking that people actually earn more and more and more, and then they retire around in the mid 60s.
Well, again, I think that one could change that assumption. I guess I'm wondering if you're looking at the net present value of somebody's human capital, which begins to, it peaks and then, begins to decrease through time. I'm not quite sure if you're looking at a specific chart, but
well,
again,
yeah, I mean, those curves are based on the data. There was an analysis done of people's salary paths. So maybe as you get towards the end there, maybe you're working fewer hours.
Yeah.
Then you have, something like that.
Yeah, it's just interesting.
But this is all data driven though.
Yeah. No, it's interesting. No, so I'm just pulling it up here so that the people can see what I'm talking about. So it's not too confusing, but these are the curves that we're looking at. We love looking at curves, being numbers people. No, that's great. Thank you. So other question here. I was thinking also about when we talk about human capital, we also talk about human liabilities, and because we want to build up the whole balance sheet approach, maybe we should hit a little bit on, we mentioned it already a couple of times so that people understand what are we talking about here.
Well, first of all, we don't use the term human liabilities. We simply say liabilities here. And basically it's like we said, it's like any, your liabilities are things that you have to pay for. So that would certainly include, the basics, food, clothing, shelter. They, as Tom mentioned, they could, if you do have outstanding student debt, you would include that as well. But basically, it's the things that we call them non-discretionary because you just don't have any discretion over these things. You have to spend the money on those things.
And then we've labeled these liabilities here. Again, maybe that's kind of a holdover from the kind of the corporate balance sheet world where there are legal liabilities. For a given individual, they may in fact have some legal liabilities, but we think of in more general terms of their non-discretionary consumption, which could be a soft liability or a hard liability or a legal liability. Those are just kind of labels. At the end of the day, within this kind of liability bucket that you see in this holistic investor profile that includes one section is their balance sheet by itself. The part that's labeled liabilities is really referring to just non-discretionary consumption, which is probably a mix of actual legal liabilities and then things that we're treating as liabilities, even though they're not quite liabilities, but they do represent needed consumption to survive, like Paul said, food, shelter, etc.
So maybe we should start explaining what we're looking at from the top here. We have the word pecuniary. It's a complicated word. What does that mean? And what does that mean in this context?
Paul, I'm happy to go, but so I guess we're looking at it, what we would think of as a holistic investor profile. And then we kind of, in our world, we kind of think of, there's different, preferences that people have. In the words, we're using the word pecuniary, which you could substitute in the word financial in nature. and then non-pecuniary, or it would be non-financial. And so at the far right, you see, faith-based, values-based, ESG. These are kind of preferences that might be, deemed non-pecuniary or non-financial. And then people have, pecuniary preferences. And a major point that we're trying to make in the book is that we need to now go beyond risk tolerance. And, we highlight 4 other, I'd say, I'm going to call them preferences that enter life cycle models. 2 of them relate to kind of, consumption, and 2 of them really relate to the idea of, am I more concerned about my own, I guess I'll call it consumption, or am I concerned about leaving a bequest for my heirs? And it's, again, we're advocating that one should be thinking about investors holistically, moving beyond risk preference to think about these other preferences. And then when you combine these other preferences with their actual situation as represented by their balance sheet, that's where we'll be able to start making those big picture financial planning decisions around, should somebody be buying a life insurance? When you're old enough, are you going to need an annuity, and how much should you be consuming, and how much you should be saving? Again, the strategic oriented questions around a financial plan.
Exactly. It's a schema of all the things that go into the model. This is not the model. It's it shows what components are going into it. Yeah.
Yeah. Well, these are inputs to the model. It's not the model. Exactly. And these are the inputs that come that basically come from the investor. And, the idea would be to solicit these preference parameters by using questionnaires of the investor. So not only to get at the risk tolerance, but to get at these other preferences as well. And then there's pecuniary versus non-pecuniary preferences. Pecuniary preferences are basically things that are going to relate to consumption. The non-pecuniary preferences can come in when you actually build a portfolio, and you might, for example, be an investor for whom ESG is very important, and you might be willing to give up some return in exchange for higher ESG scores on the on the assets in your portfolio. So that's when these non-pecuniary preferences would come into play.
Yeah, that makes sense. So going back to what where we put the human capital there, we talked about the university professor. On the other side of that scale, right, as you mentioned, Thomas, is this the investor, person who's running his own fund maybe, or stuff like that. Where does the line, maybe it's difficult to draw a line, but we talk about that as that person's human capital. To what extent, when does it become financial capital though? Like if I'm an investor in my own company and it's all about me getting a return when I sell my stocks, such and such down the line, that's all money coming in as like in a financial investment, even if it's my company. Like how do we think about when to know what bucket to put it in, human financial capital?
Well, I'll just say that's a great question, though, that I hadn't thought much about.
Okay. Yeah. Well, human capital, remember, it's about projecting future cash flows and then discounting them to the present, whereas financial capital is actual financial assets. You convert human capital to financial capital when you save. So, so if this business you're talking about, you'd have to say, well, what is, projecting future income from it, versus, how is it, working as an actual, as a financial asset. That would be the distinction, because, as a financial, if I the money I make out of it, I invest it into my portfolio, then it's becoming financial capital.
Right. I would agree with Paul here that in your example, it's ultimately become financial capital. The more typical example is, think about somebody's, paycheck, for a typical person, not somebody that's, this kind of entrepreneur in that kind of startup world. 90% of a typical person's, paycheck, goes out the door right away, to pay for ongoing living expenses, rent, food, life, if you will. And, 10% or maybe less is, of that each paycheck is saved. But it's that act of saving that is, slowly and methodically converting one's human capital into financial capital.
Yeah, I can just imagine a certain. So some people who say, I'm such a good investor, I'm just going to live off investing my own money. We sit down and it's all financial investment. You would say you have no human capital because it's all financial capital. But the closer I get to that company, well, now I'm on the board and now I'm the owner and I'm a third of an owner. And eventually, if it's my own company, we think of it as kind of more a human capital because it's not just portfolio investments. So
right, I do think you can construct an example that will blur the line.
I'll work on that for the next time we talk. So then I have the perfect example to show that there isn't such. So maybe we should just hit on the holistic part here of investors' balance sheet. We showed the picture there. We have the different parts here. Thank you for pulling that up again. So what else should our viewers take away from this? We have the components here. We're going to ultimately make sure that the one maximizes one's utility on the basis of that. Anything else that we should leave our viewers with, kind of with this picture in their mind as we jump before we have our next conversation here?
I almost feel like this brings us full circle, and with this, picture is kind of a way to circle back where we started, which is, if you zoom in there, right, you get to see the components of the individual balance sheet. On the left side of that balance sheet, right, you have financial assets and human capital. Then on the right, you have liabilities. The difference between assets and liabilities is your net worth. And then off to the left of that balance sheet, we have, the 5 different investor preferences, where one of them, the one we've been talking about mostly today, risk preference, that risk preference really influences that entire, should be thought about in the context of that entire balance sheet, as opposed to a single square or a sleeve of that balance sheet, which is the financial assets. And again, so big picture, we're arguing for being big picture, being holistic.
No, that's great. And one thing maybe to hit on too is that we talk about human capital as both a stock and flow, because it's derived from the flow, right? So if we think about an income of a person who is employed, that's that person's human capital. But here we created a balance sheet part of it, and it might sound, some people might be confused because they're saying, well, how can it be both on the balance sheet and on the income statement, so to speak, as a flow? But that's the whole idea, right? You have a machine. The machine is what's going to produce your flow of cash, which means that you have it both on the balance sheet and income statement, so that's not a confusion. But maybe a very new concept here is all the consumption, like how in the liabilities, we just have liabilities here, but in the liabilities are non-discretionary consumption, right? And that too, we kind of think about something you can discount, and the risk of that is also something you can discount. And that also becomes a stock part of the balance sheet.
Yeah, everything on the balance sheet is a stock item, right? And then the income statement would be a separate statement that shows the flow, the basically the cash flows, what happened. So what would be on the income statement would be, income, it's like salary over a year, and then things that come out of your investments and other things like if you own an annuity, the annuity payment and so on.
No, perfect. All right, and next time we will be wrapping all of this together in a great framework, so that to really take this home. So I hope that people got the components that we talked about today pretty clear in their head. And with that, I think I'll wrap it up. Anything that we feel like we missed to really clarify this?
Nope, we're good.
All right. I think we're good. And we're already gearing up for the next conversation. So thank you so much for tuning in. This has been the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. Today with me were Thomas Idzorek and Paul Kaplan. Thank you so much for watching and listening, and see you next time.
For more information, please visit rpc.cfainstitute.org/research-foundation.